Morning, good afternoon, or good evening. I'd like to welcome you all to the second session of the China-Africa Research Initiative, CARI, annual conference. This year our conference is on China's overseas lending, and it's in comparative perspective. So we've got panelists and speakers talking about Chinese lending in all parts of the globe, not just in Africa. We started last week with our first session on Chinese lending in countries in debt distress. And this week, I'm very pleased to introduce our speaker, Kristen Hopewell, and I'll introduce her in just a moment. But before I do that, a little bit of housekeeping. First of all, let me thank our funders, the Carnegie Corporation of New York, without whom our work would not be possible. And also Marie Foster, our program coordinator, without whom our work would not be possible. The SAIS IT team, which is behind the scenes in all of this, making sure everything runs smoothly as we carry our work out on Zoom. So thank you to everyone. And now to our speaker, Kristen Hopewell. Kristen's work in international political economy has been making academic headlines for quite a while now. She's done 2 books, Breaking the WTO, which was published by Stanford in 2016, and her more recent book, Clash of Powers, US-China Rivalry in Global Trade Governance, so Cambridge University Press in 2020. And it's that book and that research that she's going to draw on today. We've asked her to speak about China and global norms on export finance. And as many of you know, China's overseas lending, particularly in the developing countries and the poorer countries, is predominantly export finance from China Export-Import Bank. So we're really interested to hear what Kristen has to say today. Kristen today is the Canada Research Chair in Global Policy at the School of Public Policy and Global Affairs at the University of British Columbia. So we will also have 2 very distinguished discussants, and I will introduce them after Kristen speaks. So for this session, the chat is not available to the audience, so please post your questions and answers, or your questions, and we'll give the answers in the Q&A function. Although in the chat function, you can find the detailed bios of today's speakers. And so at any point you can put your questions in, but please specify to whom your question is meant, and also let us know who you are and what organization you represent so we can get to know you better. All right, so Kristen, over to you.
Great, thanks, Deborah. I'll just get my PowerPoint slides up here. Great, so I want to thank Deborah BRAUTIGAM and the China-Africa Research Initiative for the opportunity to be here today, and also to thank Marie Foster and the rest of the team for doing such a great job organizing the event. I'm very excited to have the opportunity to present material from my new book, Clash of Powers, US-China Rivalry and Global Trade Governance. And I want to thank the funders of the research behind the book, the UK Economic and Social Research Council and the Global Challenges Research Fund. So as we know, trade has become a flashpoint of conflict between the US and China. We've seen a dramatic escalation in trade tensions between the world's 2 largest economies. Attention has overwhelmingly focused on their bilateral trading relationship. Things like the size of the US trade deficit with China, allegations that China is engaged in unfair trading practices, and recently the US imposing tariffs on Chinese imports and igniting a trade war. In this book, I focus on a critical aspect of their growing rivalry that's been largely overlooked, and that's their battle over the global institutions and rules governing trade. For over 70 years, the US has been the dominant state in the global economy and its governance. As John Eikenberry puts it, from its position as global hegemon, meaning the world's dominant power, the US effectively ran the system. It constructed the institutions of global economic governance, like the World Trade Organization, the WTO, the International Monetary Fund, the World Bank. And these institutions served as an important channel for the projection of American power, and their rules also reflected its primacy. But now, after 4 decades of rapid and sustained economic growth, China has emerged as the world's leading trading state and 2nd largest economy. So this has given rise to 2 major debates. First, are we in the midst of a hegemonic transition from the US to China, or does the US maintain its dominance? And second, how will the rise of China affect the system of global economic governance constructed under US hegemony? So the book intervenes in each of these debates by analyzing China's impact on global trade governance, which is really at the heart of the US-led liberal international economic order. And by liberal international economic order, I'm referring to the institutions, rules, and laws that were created under US hegemony. This is typically referred to as a liberal order because it's been broadly based on the principles of open markets and free trade. So in the book, I focus on two key institutions for governing trade: the WTO, which is really the core institution created to govern the trading system and a key pillar of the US-led LIEO, and also the OECD arrangement on export credit, which has received much less attention from scholars, but as I show, also plays a critical role in maintaining the liberal trading order. So many dismiss claims about the rise of China and a decline in US hegemony as exaggerated or overblown. They point out that by virtually every conventional measure of power, whether economic, military, or soft power, the US still has a huge lead, as Daniel Drezner puts it, and remains vastly more powerful than China. Even just in economic terms, for example, the Chinese economy is still only about 2/3 the size of that of the US. So this has led many to conclude that China is not an imminent threat to American dominance, and the US remains secure in its position as the world's sole superpower. Comparisons are frequently drawn to earlier erroneous predictions in the 1980s and 90s that a rising Japan would surpass the US and bring an end to its dominance, with the argument being that China's purported threat to American hegemony will prove similarly fleeting and illusory. With regard to the second debate concerning China's impact on global economic governance, many assume that since China has benefited from an open and rules-based trading system, which has enabled its remarkable economic growth and development, that it's therefore heavily invested in maintaining that system. The general consensus, even among scholars coming from very different theoretical perspectives in international relations, is that China is not seeking to overthrow the existing global economic order, but instead is fundamentally supportive of its overarching goals and principles and seeking to sustain it. So much is seen to rest on the willingness of the US to incorporate China into existing global governance institutions and to give it appropriate weight and authority in decision-making. If so, it's argued that China will readily integrate into and support those institutions and that they'll continue to function smoothly and effectively. So in sum, the prevailing view is that the US maintains its dominance in the international system. China does not possess sufficient power to pose a real threat to US hegemony. And even if it did, China would likely support rather than challenge the existing system of global economic governance that the US has created. The book, however, challenges each of these assumptions. I argue that China's rise has in fact proven far more destabilizing, both for US power and for global economic governance, than previously recognized. I show that China has proven a significant counterbalance to American power that sharply curtailed the US's institutional power, meaning its power over the institutions and rules that govern the global economy. Existing trade institutions created under US hegemony are being undermined, and American efforts to construct new trade rules have been repeatedly thwarted by a rising China. Despite the US's superior power resources, its greater levels of economic, military, and soft power, China has been able to persistently block the US from achieving its objectives across a wide range of different areas of trade governance. Amid the rise of China, I argue, the US's ability to dominate the governing institutions of the trading system and to write the rules of global trade has been substantially weakened. So in contrast to the assumption that a rising China can be smoothly integrated into the system of global economic governance created under US hegemony, I show that China's rise has created serious challenges for the multilateral trade regime. The US and China are engaged in a struggle over the rules of the game, and specifically whether and how the rules will apply to China. I demonstrate that this conflict between the two dominant powers has profoundly undermined the established system of global trade governance by eroding the efficacy of existing institutions and blocking global rulemaking in trade. So the result is that institutions that are essential to ensuring stability and order in the international trading system have been severely weakened. I construct this argument by drawing on field research conducted over an 11-year period at the WTO in Geneva and the OECD in Paris, as well as in a range of national capitals. draw on 3 sources of data, over 200 interviews with trade negotiators, senior government officials, and representatives of industry and NGOs, extensive documentary analysis, and direct observation. So the book examines a number of different areas of global trade governance: comprehensive trade round, the Doha Round, standalone negotiations on agriculture and fisheries subsidies, which have taken place at the WTO since the collapse of the Doha Round, the governance of export credit, and also negotiations on export credit specifically for coal-fired power plants. So part of the goal of the book is to go beyond a narrow focus on US-China relations to examine the broader systemic implications of the power struggle between the US and China. In other words, to show why US-China rivalry matters, not just for great power politics or for the interests of these 2 particular countries, but because this rivalry has critical implications for vital areas of global governance and policy. What several of the cases underscore is that the breakdown of global rulemaking in trade has significant consequences, not only for the governance of global markets and trade, but also for efforts to try to use trade rules to address pressing global problems related to both global development and the environment. So I'd be happy to talk more about some of those issues related to development and environment, or the larger book in the Q&A. But for now, I'm going to focus on one specific case, the impact of China on the export credit regime. And this has also been published as a standalone article in the journal Regulation and Governance. Now, export credit is an area that's received comparatively little attention from scholars of global economic governance. And that's in part because until recently, this was a fairly quiet area of global economic governance that worked relatively smoothly and without incident. But as I show, it's become an increasingly contentious area of economic policy and international negotiations. So export credit is the use of loans and other forms of financing by states to promote their exports. And if it's provided at below market rates, state-backed export credit may act as a form of export subsidy and therefore have significant consequences for international trade patterns. The existing system of governance for export credit was created under the auspices of the OECD, the Organization for Economic Cooperation and Development, in the 1970s, and it's been repeatedly strengthened since then. It limits the ability of states to use export credit to subsidize and thus artificially boost their exports. And for decades, this has been held up as an example of a successful global governance regime, with its system of disciplines proving highly effective in restricting the use of export credit as a form of state subsidy. However, I demonstrate that the rise of China has profoundly altered the landscape of export credit and disrupted its governance arrangements. Over the past 2 decades, there's been a dramatic expansion in the use of export credit by China. China has emerged as the world's largest supplier of export credit, providing volumes of financing 4 times greater than any other state. State-backed export credit is a key tool of China's development strategy, used to foster industrial upgrading and the international expansion of its domestic firms and industries. As I show, the US and other established powers have attempted to either incorporate China into the established global governance regime for export credit, or to engage it in the construction of a new regime. But China has refused to accept any international disciplines on its use of export credit. As a result, I argue this explosion in the use of export credit by China is eroding the efficacy of existing international rules intended to prevent an export credit subsidy war. I contend that the disruption of the export credit regime highlights the conflict between the liberal principles of the existing global governance architecture and the economic development objectives of China and other emerging powers. So this last point is important because within the existing literature, there's often been a tendency to take for granted the inherent goodness and desirability of the liberal economic order created under US hegemony. And so it's frequently assumed that China's goals must be illegitimate if they clash with the existing US-led liberal international economic order. Much analysis of China, as well as other emerging powers, has been shaped by a narrow framework for understanding their agendas and impact. If they do not support the status quo, rising powers are often labeled spoilers or shirkers. The disruptive effects of emerging powers are attributed to the fact that they're irresponsible troublemakers who hold inappropriate core values and lack an adequate sense of international civic duty. But I argue that the case of export credit problematizes these interpretations. While China's rise is indeed disrupting the global governance of export credit, it's not simply because China is irresponsible or recalcitrant, as many allege, but because it has important objectives that conflict with the overarching goals of the regime. The export credit regime is a quintessential liberal economic governance regime. It's based on the principle of minimizing state intervention in the economy, preventing states from distorting markets and trade, and ensuring that competition in the global economy isn't distorted by state subsidies. The US and other established economic powers have an interest in preserving this liberal regime that they've created, with states voluntarily cooperating to avoid a costly and self-defeating subsidy war. Whereas China and other emerging powers have an interest in maintaining their ability to use export credit as part of their strategies for national development. So this is, in short, I argue, a clash between liberalism, meaning specifically economic liberalism, and development. So to briefly provide a bit of background on export credit, every major economy in the world has an export credit agency, an ECA, that provides various forms of financing to facilitate and expand exports. This includes things like direct loans to foreign buyers, insurance and loan guarantees, and finance for large-scale infrastructure and industrial projects. States provide about $300 billion in trade-related finance annually. Export credit can be used to address market failure, with ECAs stepping in to fill gaps in the availability of private financing, but export credit is also used as an important tool of industrial policy and export promotion. State-backed export credit is concentrated in capital equipment and services sectors, so-called big-ticket exports, things like aircraft and satellites, industrial plants, infrastructure projects, energy projects, and so forth. States are heavily involved in long-term export financing, particularly for complex multi-billion-dollar sales. And state-backed export credit is particularly important in facilitating sales to emerging markets, where less developed banking and capital markets often limit the availability of private financing. So to provide an illustration of how this works, in the US Export-Import Bank supports the exports for many American capital goods sectors, but here I'll take aircraft as just one example. The US Exim Bank supports the US aerospace sector by supplying financing to facilitate the sale of Boeing jets to foreign buyers. Given the size of these transactions, a single aircraft can cost as much as nearly $500 million. The purchasing airlines rarely pay cash, but instead they require loans in order to make the purchase possible. So the US Exim Bank can step in to provide direct loans when commercial financing is unavailable, or to guarantee and thereby reduce the cost of commercial loans. So aerospace is just one example of the many types of industries that are supported by the US Exim Bank and its counterpart ECAs around the world. One thing that's important for the story here is that export credit is a key tool of the developmental state toolkit. Virtually all of the recent successful late developers, such as Japan and the East Asian NICs, the newly industrialized countries, have used export credit as a key part of their strategies for economic development and catch-up. Now, the principal governance issue related to export credit arises from the fact that it may be subsidized by states as a means to make their exports more competitive, which can quickly lead to a destructive competitive spiral of state subsidization via export credit. So if one country uses export credit subsidies to give its exports a competitive advantage in global markets, other states will respond in turn by increasing their subsidies. And quickly you can get into a situation where countries are spending massive amounts of money in a competitive battle to try to support their exports. Not only would that distort trade, but it would also drain national budgets. And this is in fact exactly what was happening in the 1970s and what prompted the creation of the current regime governing export credit. So export credit is governed by a set of rules established at the OECD, an institution comprised primarily of advanced industrialized states and thus often described as a so-called rich man's club. The OECD arrangement on export credit was created in 1978 in the context of a global subsidy war based on export credit. The arrangement's disciplines place strict limits on the financing packages that states may offer to borrowers, defining the most favorable terms under which credit may be granted. And over the past 40 years, the arrangement has been continuously revised and updated to tighten its disciplines. Now, this governance regime was very much a creation of US hegemony. The US was the key driver behind the creation of the arrangement, as well as the continual strengthening of its discipline over all of these years. sometimes using fairly aggressive strong-arm tactics in order to force other countries to cooperate and participate. So back in the 70s and 80s, for example, countries like France and Japan, which had more interventionist economic models, were reluctant to accept disciplines on their export credit subsidies. But the US used its coercive power to overcome their resistance and force those countries to participate and accept disciplines on their use of export credit. So the goal of the US has been to bring the global provision of export credit closer to market principles so that states weren't using subsidized financing to distort trade. And that is, in fact, exactly what's happened. This is what the key provisions of the arrangement look like today. Some of this is fairly technical, and it's not necessary to go into too much detail, but I wanted to provide a brief sense of how its disciplines work. So the most obvious way that states can subsidize export credit is by providing a below-market interest rate. And even a relatively small change in the interest rate makes a big difference in the cost of a loan. So the arrangement sets out a minimum interest rate that states are required to charge in issuing a loan. But interest rates are just one part of the story. There are also many other factors that go into determining the cost or the attractiveness of an export credit loan. If any of these other elements departs from market conditions, it could act as a subsidy and be used by states to give their exports an unfair advantage. So the arrangement regulates each of these key terms and conditions of export credit lending in order to ensure a level playing field amongst its participants. And the arrangement also contains strict rules on tied aid, meaning aid that's tied to the procurement of goods and services from the donor country. Because it operates similarly to export credit, if it wasn't regulated, tied aid could be used as a way to circumvent the export credit disciplines in the arrangement. And that would have negative consequences, both for trade, but also for development as well. In addition, the arrangement also has specific rules governing export credit for certain sectors, as well as provisions governing environmental and social due diligence, debt sustainability, and corruption. And one of the key features of the arrangement is that it has very strict transparency and monitoring requirements. So every time a state provides export credit, in advance of the transaction, it's required to report to the other participants in the arrangement and provide a full confidential disclosure of the terms of that transaction. So there's real-time transparency and no secret financing terms. States know exactly what their competitors are doing, and they can confirm that they're following the rules. So this works as effectively a built-in surveillance mechanism to ensure that no one cheats on the agreement. And although the arrangement is an informal, consensus-based so-called gentleman's agreement, it's nonetheless proven remarkably effective. It succeeded in virtually eliminating the subsidy component of export credit amongst its participants. So from a global governance perspective, as I said earlier, this is considered an extremely successful, effective governance regime. In recent years, though, the global landscape of export credit has changed dramatically due to an explosion in export credit provision by China as well as other emerging economies. Since 2000, the BRICS, Brazil, Russia, India, and China have increased their official export financing from less than 3% to 40% of the world total. And the vast majority of this increase has come from China, who constitutes 90% of the export credit activity of the BRICS and is now the world's largest export credit provider. So China has 3 ECAs, the Export-Import Bank of China, Sinosure, and the China Development Bank. And through these 3 institutions, in 2014, China supplied $58 billion in export credit support, far more than the $12 billion provided by the US, and indeed more than all of the G7 rich countries combined. And on top of that, it also provided an additional $43 billion in overseas investment financing to promote its exports. So as you can see here, these are the world's largest users of export credit. And as one US official said about China, they just dwarf everyone else. The other emerging economies are also becoming increasingly important users of export credit, particularly in certain strategic sectors, such as Brazil in construction, aircraft and mining, Russia in energy, and India in energy and infrastructure. But as you can see here, they're still nowhere near the level of China. So export credit is a key part of China's development strategy. It's one of the prime means by which China is deploying its newfound financial power, including its massive foreign exchange reserves, to give its firms a competitive advantage in global markets, while fostering industrial upgrading and the development of strategic sectors. So what China does is first develop an infant industry domestically, and then it uses export credit to enable firms in that industry to expand globally. First, by moving into emerging markets in Africa, Latin America, and developing parts of Asia, and then into more advanced economies. And this has been critical in enabling China to move up the value chain from low-wage, low-value manufacturing into more technology-intensive and higher value-added industries, where it's increasingly competing directly with advanced industrialized countries like the US. Export credit plays an important role in China's Made in China 2025 industrial strategy, where China is seeking to foster the development of more sophisticated, advanced manufacturing in order to enable its manufacturing sector to catch up with and eventually surpass the advanced industrialized countries to become the world's leading manufacturing power. So export credit is an essential part of China's effort to try to escape the middle income trap and develop into a high income country. And export credit has been the driving force behind the expansion of China's activities in Africa, Latin America, and elsewhere. As Deborah BRAUTIGAM has shown through her very careful and rigorous analysis, while often mistakenly described as aid, most of China's much publicized lending to Africa and other parts of the developing world is in fact export credit, loans tied to the export of Chinese goods. And similarly, much of the financing for China's Belt and Road Initiative, where China is building power plants, ports, high-speed rail lines, and other infrastructure across large parts of the world, much of that financing for the BRI is also in the form of export credit. So China has been characterized as conducting the most aggressive export credit financing campaign in history, and this strategy is proving highly effective. To quote one trade official, in almost every capital goods sector, China is going from being a bit player to being one of the biggest. China's use of export credit is seen as a serious competitive challenge to advanced industrialized states like the US and a significant threat to the export credit regime. The issue is that China is not a member of the OECD or bound by the rules of the arrangement. And given the scale of its export credit support, its non-participation threatens to undermine the established system of global governance for export credit. Many OECD countries believe that China is using its ability to extend export credit on more favorable terms to gain an advantage over participants in the arrangement. So to quote one official, what China is doing is riskier transactions with fewer rules, slightly less cost, longer terms, and a lot more flexibilities. When you combine all of these things, it can be quite an attractive package. Since financing can often account for as much as 40% of the cost of a project, attractive export credit terms give China's exports a significant competitive edge. If we go back to this slide setting out the key provisions of the arrangement, for China, deviating from the arrangement on any of these terms can be used to undercut competitors who are required to abide by these rules. And there is evidence that China is providing export credit that violates virtually all of these provisions, including subsidized below market interest rates, low or no risk premiums, considerably longer repayment periods and grace periods, as well as violating the arrangement's rules on tied aid. So rail equipment exports provide an illustration of how China's ability to provide more favorable credit terms advantages its firms and helps to drive its process of industrial upgrading. This is a big market, valued at about $120 billion a year, and it's also one of the 10 priority industries that the Chinese government has targeted for overseas expansion as part of its effort to transform China into an advanced manufacturing powerhouse. China now has the world's largest high-speed rail network, and its firms participate in hundreds of overseas rail projects. In 2015, China's two state-owned rail equipment makers merged to create CRRC, an industrial giant that dwarfs its rivals. CRRC has been aggressively targeting emerging markets in Africa, Latin America, and Southeast Asia, as well as increasingly winning big contracts in advanced countries. According to industry analysts, although China's rail technology is less sophisticated, its main competitive strength is that its technology is offered as part of a package that includes highly competitive export credit financing. So here are just a couple of examples. And it's important to remember that even just a slightly lower interest rate or premium fee can give Chinese exports a significant cost advantage. So a difference of just 1 to 2 percentage points, for instance, in the interest rate increases the total financing costs of a 12-year loan, for instance, by about 18 to 30%. So even small differences in rates can make big differences in terms of overall costs of a loan. So to provide a couple examples, on a sale of rail infrastructure to Pakistan, China's Exim Bank offered a risk premium fee of just 8%, while the arrangement requires a minimum fee of 21%. On a sale of rail exports to Argentina, the China Development Bank charged an interest rate of LIBOR plus 6%, well below market rates of at least LIBOR plus 9.35%. In addition, extended repayment periods also significantly increase the attractiveness of financing. They allow the importer to discount the loan over a longer period of time and also help shift the risk to the lender. While the arrangement allows a maximum loan tenor of 12 or 14 years for rail exports, China's repayment terms often exceed 20 years and have even been as high as 30 years. So these differences in interest rates, in fees, and in repayment terms provide China's exports with a significant advantage over its OECD competitors. And they've played an important role in helping to fuel CRRC's global expansion. So the traditional big players in this sector, Germany's Siemens, France's Alstom, Canada's Bombardier, and the US's GE, are all finding it extremely difficult to compete with CRRC and the cheap credit that its exports receive from the Chinese government. Siemens and Alstom, for example, recently sought to merge in an attempt to better compete with CRRC. France and Germany effectively wanted to try to create their own European champion in this industry, but they were blocked ultimately by EU antitrust regulators. GE has had to sell its rail business, and Bombardier's rail business has also been increasingly struggling. So rail is just one example of the many industries where China is using more favorable export credit terms in order to give its firms a competitive edge in global markets. The information and communications technology sector provides another example, and this is again another industry that's been targeted as a priority under China's Made in China 2025 industrial strategy. China's export credit agencies have aggressively supported the international expansion of its ICT firms. China Development Bank has provided Huawei, for example, with a $30 billion line of credit, which has enabled it to offer below-market financing rates and terms that are unmatchable by its competitors. Fueled by this kind of massive financial support from the Chinese government, Huawei has become the world's largest telecommunications equipment manufacturer, overtaking Ericsson, the European multinational, in 2012. Similarly, the global expansion of ZTE, another major Chinese telecom equipment manufacturer, has been driven by $25 billion credit lines from CDB and China Exim Bank. So in this way, China uses cheap export credit to support the development of national champions and to fuel their global expansion. Now, OECD export credit agencies are receiving mounting complaints from their exporters that they're losing contracts to Chinese firms because of the more favorable financing packages that China is able to offer. In the words of the US Export-Import Bank chair, they're winning deals in part because they're not playing by the rules. As one ECA official from an OECD country stated, we've seen them coming into areas where they're competing with our exporters, often with very cheap money and often with tied agreement. Thus, as another bluntly put it, everyone feels under attack. So this has raised significant concerns about the future of the export credit arrangement. An arrangement participant summed up the situation as follows. You have this arrangement that's worked well for decades, and over time has gotten better and better as its disciplines bite more and more. The problem is that they were universal rules. Everyone who exported capital goods was a member, but now the world has completely changed. Now there's almost no sector where China is not a major exporter of capital goods. What happens to your export credit arrangement if China is not a participant? If the arrangement is going to operate in a meaningful way, it has to involve all the major exporters of capital goods, meaning it has to involve China. Everyone who exports capital goods needs to be part of the system, or it can't work. So given the massive volume of financing that it's providing, incorporating China into global rulemaking and disciplines on export credit became a key priority of the US, EU, and other advanced industrialized states. As the head of the US Exim Bank put it, it's important that they play by the rules that everyone else is playing by. Now, although based at the OECD, states are not required to be OECD members in order to participate in the arrangement, the export credit arrangement. Any state that's a major provider of export credit is eligible to participate. So the US has strongly pressed China to join the OECD arrangement, but its efforts have been unsuccessful. Beijing has indicated that it will not join a set of rules that it played no role in creating and that don't reflect its development objectives. China's position, as articulated by a high-ranking official in the Ministry of Commerce, is that the OECD arrangement aims to solve the problem of international competition among developed countries and does not reflect the development concerns of developing countries like China. So as a result, China has refused to join the OECD arrangement or subject itself to its disciplines. There are thus fears amongst the OECD countries that the arrangement risks becoming obsolete. As one negotiator put it, the arrangement becomes pretty irrelevant pretty quickly if the world's biggest exporter won't participate. So thwarted in its efforts to convince China to join the arrangement, the US tried a different tact. In 2012, the US drove the creation of a new international working group on export credit, involving 18 major developed and developing countries, including China, in an effort to try to negotiate a successor to the OECD arrangement that would actually encompass the emerging economies. This was a US-led initiative pushed at the highest levels that came out of the bilateral US-China strategic and economic dialogue and meetings between then President Obama and President Xi Jinping. And it was China that insisted on the participation of 8 other emerging economies in order to ensure balance between developed and emerging economies and to try to bolster its side in the negotiations by ensuring that it wouldn't be outnumbered by the OECD arrangement participants. So as a result, compared to the arrangement, the IWG was actually considerably more inclusive in that nearly half of its participants were developing countries. From the perspective of the US and other developed countries, the IWG was very much a second best solution. As one US negotiator put it, we had dreamed of dragging China into the OECD arrangement, but the failure of that effort is what led to the IWG. So seeking to rein in export credit provision by China, the IWG represented an attempt by the US to maintain a liberal regime of export credit governance by replacing the arrangement with a new version that would incorporate the major emerging economies. The US identified this as a key strategic priority in its economic relations with China, and negotiators report that it pushed China very hard to enter into and engage in the negotiations. As one US official stated, everyone's hopes are resting on the IWG, that it will be able to control China's ability to take everyone's lunch. Other OECD countries have backed the US and placed similar emphasis on the IWG as a means to create new, more universal rules on export credit. But given the centrality of export credit to its development strategy, China has little reason to subject itself to international disciplines. A negotiator for an OECD country summed up the situation as follows. China has vast resources. The amount of money available now is almost beyond belief. Their view is, why the hell should we agree not to use those resources? These guys are trying to constrain our ability to achieve our rightful place in the world. They don't see anything in it for them. It's not in their interest to accept these constraints. They provide so much export credit, it's astounding. Besides the Chinese, the US Export-Import Bank looks like a corner bank in Ames, Iowa. China is doing this on a scale that just dwarfs what's happening in the rest of the world. Why should they let anyone stop them? So consequently, although China formally agreed to participate in the IWG, it consistently thwarted the negotiations. Despite intense pressure from the US, as well as other advanced industrialized states, China really refused to budge. In fact, it refused to take even the first preliminary steps that would be necessary for negotiations to begin in earnest, including, for example, refusing to provide even basic information about its export credit programs. So as a result, as one negotiator stated, the process has been going on for years and there's been zero progress. States have been meeting multiple times a year for negotiations, but China was foot dragging, throwing up all kinds of process-based hurdles, and basically doing everything that it could to impede the negotiations from moving forward. And of course, nothing could move forward without China. So states were going through the motions, they were continuing to meet regularly for negotiating sessions, but there was a huge amount of frustration amongst negotiators from the OECD countries that this was really ultimately a futile process. According to a senior US official, quote, "What the US, EU, and other OECD members want is a new version of the arrangement, a comprehensive set of rules that incorporates the emerging economies. But that's exactly what China is not going to agree to." So after 8 years of effectively fruitless negotiations and with no prospect of any agreement on the horizon, the IWG was officially abandoned at the end of last year. The simple fact is that China has little incentive to accept disciplines that would limit its use of export credit and thus potentially inhibit its future growth and development prospects. And it's a sign of China's power that it's been able to successfully resist being pressured into a set of rules that it sees as fundamentally against its interests. So to conclude, as the case of export credit, as well as the other cases analyzed in the book show, global trade governance has been profoundly destabilized by the rise of China. As analysis of the OECD and IWG negotiations shows, contemporary power shifts are making multilateral cooperation to govern export credit increasingly difficult. From its hegemonic position in the international system, the US was the driving force behind the creation of the arrangement, as well as the continual strengthening of its disciplines. However, its current inability to press China into existing or new governance arrangements suggests that the capacity of the US to steer global rulemaking is diminishing amid the rise of China. And beyond the export credit regime, we see very similar dynamics taking place at the WTO as well. In the case of export credit, China's emergence as a major provider of government-backed trade finance has proven highly disruptive to the transparent, rule-bound, orderly system for the governance of export credit. Reluctant to relinquish an important industrial policy tool that's vital to its continued development, China has valid reasons to resist external disciplines on its use of export credit. But nonetheless, its unwillingness to either join existing governance arrangements or subject itself to new disciplines threatens what has until now been a highly effective regulatory regime and risks prompting a reemergence of destructive competition via export credit subsidies. The case of export credit thus throws into stark relief the tension between the development objectives of China and other emerging economies and the American-led liberal international economic order. If development requires scope for state intervention, then can this be accommodated in or reconciled with liberal global governance institutions? From the perspective of the US and other established powers, the export credit regime and its disciplines are essential to fostering an open and fair global trading system, with competition taking place on a level playing field, undistorted by state subsidies. But from the perspective of China and other emerging powers, a system that constrains their scope for development by requiring them to relinquish their use of an important industrial policy tool cannot be considered fair. What the established powers perceive as a level playing field is in fact one that serves to perpetuate their industrial and economic supremacy. So whether and how this fundamental conflict can be resolved or reconciled is unclear, but I would argue that it represents one of the central challenges currently facing the existing system of global economic and global trade governance. So I'll wrap up there and look forward to our discussion. Thank you.
Wow, Kristen, that was great. Thank you so much. So everyone, you can see just what fascinating work Kristen's doing and why we wanted to have her speak at our conference on China's overseas lending, because as she pointed out, and a point that we've been making too, is that export credits is really what China's overseas lending is predominantly about. And so we now have two wonderful discussants, and they are going to be giving us their remarks for the next period. And so first will be Miles Kaler. Miles is a distinguished professor at the School of International Service at American University. He's also the Senior Fellow for Global Governance at the Council on Foreign Relations in Washington, D.C., where he chairs a number of interesting meetings on global governance and global economic governance. And Miles, his bio is, of course, the longer bio is listed in the chat. So Miles, we'll go right to you. Thank you so much.
Thank you very much, Professor BRAUTIGAM, and thank you and to CARI for this invitation. It's a real pleasure to comment on this new book by Kristen Hopewell. As we would expect from this author, it presents a very clear argument and detailed marshaling of empirical evidence. To a degree, Professor Hopewell joins the ranks of pessimists regarding China's rise and the US response, not because of any belief in a Thucydides trap or the inevitability of an ideological or military clash, but because China's status as an economic power in the global economy is unprecedented in the 2 centuries since the Industrial Revolution. Previously, as she points out, major economic powers were also rich, which smoothed economic conflict despite concerns over competition. The China paradox, as she calls it, is that China is both economically influential and relatively poor, a middle-income developing country, and this is most important for Professor Hopewell's argument, and intent on retaining all the privileges of that developing country status, which sets it up for persistent conflict with the United States, which views it as an economic rival and near equal with no entitlement to this status. Since Professor Hopewell cites my work, even in some cases approvingly, I should make clear that I agree with her nuanced view of China's economic rise and her emphasis on the novelty of a great economic power that is in a hurry to grow rich before it grows old. But I would argue that her account should be even more nuanced or tentative on certain points. First, an overall question of data. and estimates of power within the trade regime. Yes, China is the world's leading exporter of goods. But if we look at services, which are growing rapidly as a share of world trade, China is far down the rankings, surpassed not only by the United States, but also by the UK, Germany, and France. Those concerned about China's prowess tend to view world trade through the lens of trade in goods. And here, former President Trump, of course, is in that camp as well. Second, where is the rest of the world, particularly the EU, Japan, and Canada? Together, their combined GDP equals or surpasses the United States and China. The United States and China are the only actors in this story, it seems. The others are relegated to the status of what Professor Hopewell calls, quote, peripheral powers. I would add perhaps Professor Hopewell's academic post in British Columbia, which is sandwiched between these two economic powers, reinforces this perspective. But this omission has two effects. It removes important players in any future negotiations over the World Trading Order or the export credit regime, as the courting of the EU by both the United States under the current Biden administration and China with the EU-China Comprehensive Agreement on Investment demonstrates. The EU during the Trump administration, together with 15 other members of the WTO, including China, Canada, and Mexico, negotiated a multi-party interim appeal arbitration arrangement as a workaround for the paralysis imposed by the US on the appellate body at the WTO. And this is just one indication of the kind of influence that these peripheral powers can exercise within the trading regime as the United States and China engage in their trade conflicts. There's also a historical perspective to be added about these other powers. The EU constrained US power in the trading system at a much earlier stage. It really wasn't all about US hegemony, I would argue, although the coincidence of many of their interests made this constraint less visible than it is with the US and China. And Japan, true, Japan's rise was not precisely like China's rise. The US could, quote, successfully integrate Japan and other major economies. But let's recall, this was only after considerable conflict and protectionism in the 1980s. And of course, the big difference with China is the United States does not have the same security leverage that it had with Japan. Finally, and this is most important for assessing Professor Hopewell's identification of China's disruptive role in the world trade order, including the export credit regime, what are China's motivations for its unwillingness to accept or modify existing and relatively successful frameworks, such as the OECD export credit arrangement? I applaud once again Professor Hopewell's nuanced view of China's motivation. Although China is disruptive to the existing order, in her words, it is not putting forward, quote, revisionist ideas for international order that represent a fundamental break with the existing system. Excuse me. China's disruptive actions are largely attributed to its insistence on special and differential treatment as a developing country and its intent to continue its economic advance using a developmental state and all the instruments that developmental states have employed in the past. I would note, however, that Professor Hopewell does bring in the conclusion, very briefly, a larger strategic motivations, arguing that China's actions are part of a, quote, a broader geopolitical strategy rooted in its rivalry with the United States. But that is not a major theme of her book. It does appear in the conclusion. So in considering whether China can be brought into a reformed order that would benefit not only the industrialized countries, including the United States, but also the developing world, and I would highlight and really underscore and applaud the importance of Professor Hopewell's attention to the effects of China's policies on other developing countries, I would advance a few final points that add some optimism to her analysis. First, if it is China's claims to be a developing country that drives its reluctance to accept any constraints imposed by existing or new arrangements, we could observe the evolution of its position on that score in the climate change regime, and its acceptance first in an agreement with the United States under President Obama, and then in the Paris Agreement that China does have responsibilities to act, even if those are different responsibilities. Second is its position on export credits driven by development objectives, or by the power of domestic economic interests, and particularly the state-owned enterprises whose influence has grown under Xi Jinping, and the need for those enterprises for export subsidies to remain competitive in international markets. Now, Professor Hopewell attributes China's attachment to export credits to its, quote, industrial upgrading into more tech-intensive and higher value-added industries. And she presented in her book and in her presentation 2 very good examples, advanced rail equipment and IT. Yes, that's the case, but are these the main sectors that are being supported? From other evidence in the chapter in her book, I would say no. Most of the cases seem to relate to infrastructure, and of course, especially coal-fired plants, to which she devotes an entire chapter, which is hardly the technology of the future. So it would be helpful to have a breakdown of what kind of sectors are being supported by export credits. And I think actually the mix would look very different. It's not all dynamic sectors of the future. A lot of it is lagging sectors that are going out of business and or would go out of business without this kind of subsidy. So this is critical not only to Professor Hopewell's arguments, but also to the ongoing debate over China's position in international economic negotiations overall. Is China defending a coherent model of economic development, one on which the governing Chinese Communist Party rests its political power, or, along much more familiar lines, is it a nexus of economic interests that have captured parts of the state apparatus, interests that might weaken or change over time? Third, and finally, here I swing toward pessimism a little bit. The structure of the OECD export credit arrangement, which Professor Hopewell describes in great detail and very usefully in her book, and particularly it might make it difficult for China to sign on, particularly its emphasis on transparency and monitoring, which may make its accession difficult for China, as it has in other areas like debt renegotiation. And finally, from a point of view of developing countries, apart from those emerging economies that are using export credits themselves, and I would point out they might join the OECD coalition against China in this regard, China's competition in this domain, in contrast to fisheries and agriculture, may not be damaging to the developing prospects of developing countries. In a certain level of competition between China and the established powers, allowing once again, controlling for the quality of investments and their environmental impact, and here, of course, coal-fired power plants, most notably, may not be damaging to the developing prospects of the rest of the world, whatever the damage to the taxpayers of the industrialized world. So in closing, Professor Hopewell does not give us a solution to the problem of China's disruptive behavior in the world trading system, but her book closes with the United States under the Trump administration and its own disruptive behavior. So it could not come at a better time in the United States, at least, as the new administration grapples with how to contend with China as an economic power, only now in collaboration with other countries that are affected by its behavior. Thank you.
Miles, that was great. Thanks so much for that. Kristen, we're going to hold off. I'm sure you want to respond to all of this, but let's also hear from Jonas Bunte, and then we'll give you a few minutes to respond, and then we'll open it up to the others who are waiting. We already have a number of questions, so it's very lively in the Q&A. So I'd like to welcome Jonas Bunte. He studies the politics of finance and development, and also has a wonderful book that was published a couple of years ago, Raise the Debt, How Developing Countries Choose Their Creditors. And it's got a lot of interesting information in there that has to do with China's development finance from the point of view of developing countries, why they accept loans from the Chinese government and other BRICS, and while others reject them. So Jonas is also teaching at the University of Texas in Dallas. And over to you.
Well, thank you very much, Deborah. Professor BRAUTIGAM, thank you for the invitation, first of all. Thank you for all the good work at CARI. I really appreciate that. I've benefited a lot from that. I'm very honored to be part of this panel here with Professor Kala and Professor Hopewell. Thank you, Professor Hopewell, for really writing a really fascinating book. There's so much great about this, right? This is really wonderful to hear an account that tries to reframe the debate. It's not about comparing like the military capabilities between the US and China, but it's really trying to shift the debate towards the focus on rules and rulemaking. And this is really, really timely and really helpful. You've collected fantastic qualitative evidence. You've done more than 200 interviews with key decision makers and informants. This is a wealth of information that really shows in the book. It's very detailed, really informative on all the little things that really matter. It's really a fantastic description of what's going on. It provides us with an inside view of the negotiation. And so there's so much great about this, but I know that I have been asked to be more like constructively critical. So that's what I'm going to do. I'm going to put on my reviewer number 2 hat and be as critical as I can in order to really provide some thoughts and hopefully be thought-provoking. I have 4 bigger points, and one of which I will drop because Professor Kala already stole my thunder, but that's totally fine. Number one, a small point is on the methodology, on the, like, you've collected fantastic qualitative evidence, but I would love to have seen more information on the recruitment process. Like, after all, it's possible that there is bias in your analysis because Chinese sources appear to be underrepresented in your account of what's going on. And so I completely understand that some bias is inevitable, particularly with qualitative research, but I would have appreciated more information on the sample, because here I would have loved to learn more about what China's motivation actually is. Like, you say that they're not putting forward revisionist ideas that represent a fundamental break with the existing system, but what do they want then instead, right? Do they just want like special treatment for the moment, and then later on, like in 20, 30 years, want to get integrated fully into the existing system? We don't know that right now. And so I would have loved to know more a bit about what the other side, quotation marks, would have said. My second point is that your book is fantastic, right? It provides so much information. It is not, says the reviewer too, a theory book, right? There is relatively little analysis. There's much description, right? And so that then leads me to ask, what can we learn from this analysis for other similar cases? So the obvious example here would be the one that Professor Kahler already referred to, which is the comparison to Japan Inc. in the 1980s to China today, right? Professor Hopewell provides two very short answers or short references at the beginning of her book, saying that, hey, Japan was different than China today because, number one, there was the security dimension. Like, Japan was much more dependent on the US for security in the context of the Cold War, which is not the case today with China. And secondly, the fact that Japan was at a much higher level of development than China is today, as they were challenging the United States. And it's interesting that these are the two arguments that are being put forward, because then, in a sense, this contradicts the framing of this book right now, like where we're trying to get away from looking at military capabilities and looking at rulemaking, and here, bam, military capabilities are back in the center for explaining why Japan was incorporated, but China is not. And secondly, it really disregards some of the similarities. Like, if I understand correctly, like from the 1980s onwards, like from 1982, in fact, Japan became the largest deficit trading partner of the US, and in 1985, its biggest creditor. So that's very comparable to China today. China accounted for about 50% of the US merchandise trade deficit in 2018, which is very much comparable to the about 42% of Japan in the first half of the 1980s. And then, most importantly, both Japan and the US and China like accomplished this using very similar tools in a sense. Like, both challenges used excessive government intervention in enterprises. Like, the intention is to develop homegrown industrial champions that are protected in domestic markets in order to then later allow them to compete in the export market, right? The Japanese karetsu system, where like the corporate and banking cartels are closely tied to the government, is very similar to this like state-sponsored capitalistic system presided over by the Chinese Communist Party, right? And interestingly, like in both cases, like these development strategies were facilitated by a one-party state, right? As most of post-war democratic Japan was dominated by the Liberal Democratic Party, just as the Communist Party's one-party state in China is dominating today. And so there are all these similarities. And so I was just wondering if you can actually draw on some of your own work in order to explain this a bit better, right? So I'm really interested in the domestic political dynamics, and you have this truly excellent Ripe article about the Tea Party in the US Congress and how that might have undermined the US's capabilities of actually enforcing and forcing China to come in, just because the US was internally so hamstrung, right? Yeah, so that's one question about like how much can we learn, and secondly, I'm also not quite sure, if I'm reviewer 2 again, how much the findings talk to other issue areas. And the problem here is that the WTO and the gentlemen's agreements were quote unquote easy targets, so to speak, right? In the WTO, like each country has one vote. That we have this explicit difficulty of China being a developed and a developing country at the same time. That's unique to the WTO, though. Within the OECD export agreement, we have an agreement that's informal, that doesn't have any enforcement mechanisms, if you will, right? And so what can we learn from these two examples for other institutions that are part of the liberal order, if you will, right? Your insights probably apply to other similarly informal rules like the Paris Club. Professor BRAUTIGAM is working on that, right? But what about multilateral debt? Like the US still has veto power within the International Monetary Fund, even after the recent reform of voting shares. What about security arrangements like NATO and so forth, right? Having picked, quote unquote, again, easy targets where China really can threaten the internal functioning of institutions, I'm just wondering how much these issues then can speak to other institutions where the starting point for China to, quote unquote, cause trouble are much less advantageous. My third point was about like if your book is really about the focus on rules and hegemony, then your focus cannot just include the hegemon and the challenger, but it also has to focus on the followers, right? Those Western countries that previously or currently are still following the Western hegemon, the United States, like the countries like Germany, where I'm from, or others, right? Like if the argument is really about the liberal order, we also have to learn something about the followers and how they behave. And this is absent, as Professor Kahler already said. So I'm not going to talk more about what you call peripheral powers, but I just want to emphasize that this is indeed an issue. And then lastly, and maybe here I'm really going out on a limb mostly, I wanted to challenge your interpretation that the Chinese challenge to the United States is really that unique. Like if we're thinking about historical parallels, I'm thinking of Ha Chang's excellent work on kicking away the ladder. Kevin Gallagher and Robert Wade have also written on this, right? So just like China today, right, the US, the United States was a rule breaker at some point, right? Thinking about like the intellectual property rights regime that existed, that was in the United States was very liberal to provide intellectual property or patents to inventors without checking whether or not the invention had already been patented in the United Kingdom, for example. Similarly, the United States was just as protectionist in the past, like in order to catch up with the United Kingdom. Again, see Alexander Hamilton's infant industry argument. So it's very similar to China today. And so I'm just wondering, even if those like expectations of the hegemon at the time, the United Kingdom, weren't quite as like formalized in international institutions, they were still the expectations of the day. I'm just wondering if the Chinese challenge is really that unique, or if it's just trying to do what the US did about 100 years ago. Thank you.
So Kristen, you now have a great set of questions out there and issues. So why don't you take 5 minutes or longer to address that first round. We'll consider that the first round. I have a few others that I will add, but I'll wait until you've had a chance to address those great questions from Miles Kaler and Jonas Bunt. And maybe Miles and Jonas, could you put your cameras back on, and we'll all be here together as a panel. Thanks.
Great, thanks, Deborah, and thank you, Miles and Jonas, for those excellent comments and for such a deep and careful engagement with the book. This is fantastic. Your comments are extremely rich, and I think there's more than I can deal with in just 5 minutes or 10 minutes. So I'll sort of selectively pick and choose, but you've given me lots of food for thought and things to ponder and think more deeply about going forward. So this question of where's the rest of the world? And in the book, I make this argument that global trade politics have come to be so dominated by the US and China that other states, even big powers like the EU, Japan, India, others have really been sort of relegated to the margins and become much more peripheral powers because this US-China conflict has paralyzed trade governance at the WTO in particular. As Miles said, other states are still playing a role, particularly, under Trump and even continuing today under Biden, with the US's withdrawal from the multilateral trade system, its turn away from the rule of law, its attack on the WTO's appellate body system. The EU really did step up and try to play this role of sort of a system preserver, trying to salvage the trading system, keep the rules-based trading order in place despite this active US assault on the system. So the EU has tried to play this role, but I think the EU has been, it lacks the power of a US or China in creating this multi-party interim appeals arrangement. It did rely on China joining that initiative, and it hasn't been successful in convincing everyone to participate. It only has about 50 countries agreeing to participate in this alternative appellate arrangement at the WTO. It's lacking Japan, because Japan is so closely tied to the US. It's been hesitant to participate. It's lacking Korea. It's lacking India. So it's sort of, the EU is the next best actor to try to come forward and save the trading system amongst this fight between the US and China, but it's been insufficiently able to do so because it just lacks the power of one of these other major players. And at the end of the day, we're still waiting to see very much what's going to happen with the US under Biden, and if the US is going to recommit to multilateralism and to the WTO, and sort of save the system. The EU just doesn't have enough power to sort of fill this gap in hegemonic leadership that we used to have from the US and that's now missing. And I would argue that's true of the EU is the best shot, and it's true of all of the other countries in the system as well. I thought your question about whether China is defending a coherent economic model, whether it's really all of its policies at the international level and these global economic institutions are intended to further its scope for a developmental state, or in fact, it's being driven by more traditional, the state being captured by domestic economic interests, is a really fascinating one. And I want to think more about to what extent China is using this claim of a coherent strategy, using the claim of a coherent developmental state model that it's trying to protect as really sort of a veil for these more typical domestic economic interests. I think that's really interesting. This question of the point of view of other developing countries and what do China's trade policies mean for other developing countries is, I think, such an important one, and I think one that's largely been overlooked in a lot of our debates about China's trade policy, which have been so dominated by the US, particularly in the past 4 years under Trump. The whole debate about China and trade has come from a very narrow perspective that's largely missed the impact that China's trade policies are having on the rest of the developing world. In the case of export credit, that there's an argument to be made that developing countries potentially, yes, if China is providing heavily subsidized loans, the recipient countries, if they're getting cheaper credit, they're benefiting from that. But I think if we look at the sort of bigger picture, China's subversion of the export credit regime, its provision of cheap export credit, is potentially destabilizing this whole system and potentially risk creating an export credit subsidy war and an even bigger trade war more broadly. And so ultimately, no country has an interest in this rules-based system of global trade governance disintegrating. Certainly developing countries don't either. And so the system of liberal trading order, the rules-based system at the OECD, the WTO, this was constructed to ensure stability and order in the global economy. That's in everyone's interest, developing countries included. So to the extent that China is operating outside the rules or it's violating the rules, and that's putting the system itself under strain, prompting growing trade conflicts between the US and China, threatening to undermine the stable order, that's not in anyone's interest. And even more narrowly, looking at export credit specifically, the provisions of the OECD arrangement, some of them are quite beneficial to developing countries, ensuring, for example, that lenders are taking into consideration environmental and social governance, debt sustainability. Some of the arrangement provisions are actually critical to ensuring that lending, whether it's from China or any other country, is actually genuinely benefiting the recipient developing countries. So I think that's a real argument for why China should be participating in this regime and participating in these rules, why it matters to developing countries. And as you mentioned, some of the other cases in the book are looking at other areas like fisheries and agriculture, where in these cases, China has now become the biggest subsidizer of agriculture. China has now become the biggest subsidizer of fisheries. It has the world's largest industrial fishing fleet. And in these areas, China's trade policies are extremely harmful to other developing countries. And so trying to rein in China's trade policies through these international institutions like the WTO is critical, but that's proving extremely difficult to do for similar reasons to what we've seen in the export credit regime. So turning to Jonas's comments, and these again are fantastic. Thank you for these great comments. Your first point was about methodology and this issue of Chinese sources being underrepresented. And that's certainly true. The research for the book took place over a 10-year period. And what happened during that period is there's lots of research and interviews with Chinese officials earlier in that period where the Chinese government was relatively open to speaking to foreign academics, to speaking with the media. And what's occurred with the authoritarian turn in China is it's actually become much more difficult to access Chinese officials and to interview them in the same way that you used to be able to, or that you can interview officials from other countries. So at the WTO mission in Geneva, China's mission there, in recent years, they've been extremely reluctant to speak to academics, whereas they were quite open 10 years ago. So some of the data limitations are a reflection of this shift in Chinese government policy and access to Chinese officials. But the book does draw on a lot of interviews, particularly from the earlier period in Geneva, in Beijing, and elsewhere with Chinese officials. But there's no doubt that it's become much more difficult to get China's perspective for that very reason. This comparison to Japan is a really important one. And I think this is an area where going forward, there's going to be a need for a lot more research. I think this is one, a big area for people to be trying to understand better, delving into further. I would say the biggest difference in terms of what I'm interested in looking at, the rules-based system, the rules governing trade, the biggest difference between Japan and China is that Japan never blocked the US's institutional power, its ability to make the rules of global trade in the way that China has. The US had lots of concerns about Japanese trade policy in the 80s. This led to the rise of so-called new protectionism in the US, where the US responded with a lot of its own protectionist measures. But it never had the same implications in terms of rulemaking. So after that concern about Japanese protectionism in the 80s, the US recommitted to global multilateralism and trade. It launched the Uruguay Round, which ultimately created the WTO, which represented a profound deepening in the depth and the authority of global trade rules. So ultimately, this wound up strengthening the global trading system. Whereas with the rise of China today, I think we see the opposite, where this conflict, this inability of the US to get China to conform with the rules is actually leading to potentially the disruption of the trade regime. Finally, I'll just touch on one last thing, the point about followers, because I think this is such an interesting and important point. And what I find fascinating is that you would think if the US and China are competing for global hegemony right now, they should be competing to seek to gain followers. And in fact, if anything, I think we've seen the opposite, particularly in the past 4 years, where both of these two countries seem to be competing to alienate potential followers. So you've had Trump in the US, who not only launched an aggressive attack on China's trade policies, but on all of the US's major trade partners, using aggressive unilateral trade measures, threatening to undermine the WTO, undermining other international institutions. For 4 years, the US has been bent on alienating potential allies and isolating itself on the international stage. And China has behaved fairly similarly. Rather than trying to take advantage of this moment with the US retreating to step forward as a new leader of globalization, seeking allies, China too has been using aggressive trade measures against other states, whether that's Canada or Australia or others. It's been using bullying and coercion in its relations with other countries, and rapidly isolating and alienating itself as well. So oddly and surprisingly, rather than competing for followers, we've seen these two countries doing just the opposite. So I'll wrap up there, but thank you both again for your fantastic comments.
Great, Kristen. Well, as the moderator, I'm going to take advantage of that by asking you the first audience question. And it's just very quickly, you've already answered things so well. One of the things that's always struck me about the OECD and the Paris Club, one can include that as well, is that it's, as the Paris Club's name suggests, these are club rules, not global rules. And so how does that affect your argument, or when we look at China's engagement in these institutions? The WTO is truly a global institution. One can also argue that the IMF is a global institution. So when they're setting standards for things that I'm looking at now, like debt sustainability analyses and these kinds of rules for how they interact with other creditors for restructuring. But the OECD is even though they are inviting others in as kind of almost second-class citizens, one could say, you know, you can be part of this, but you can't be part of the OECD because, for one thing, it requires that you be a democracy to be a member of the OECD. So there's that aspect. And then the other, you've been looking at this for 10 years at least, and I wonder, along the lines of Ian Alistair Johnson, if you've seen social learning happening. You know, are the Chinese learning? It's, you know, there are a lot of different ways to analyze what's happening there, but particularly at the WTO, I wonder if there's room for that kind of perspective as well. And now let me turn to the some of the questions from the audience, and I'm going to start. Let's see. So this has partly been covered, but let me ask it again. Kobina Aydun Arkust asked, to Kristen, if you're a developing country, why should you care that China's lowering development costs, even if this undermines some so-called global governance rules? Can you provide solid reasons why developing countries might be better off siding with the OECD regime on export credits against Chinese and other emerging actors' practices? And Joris Mueller from Northwestern University asked, where's the data that you're getting on the extent of Chinese export credits coming from? Is it based on the US Exim Bank's annual reports? Because these figures are often inflated. They also include projects that have been reported but never actually committed. And I would confirm that's something we've been in contact with them about. And then Winslow Robertson, who's a PhD student and a China-Africa expert, asks, rarely does the popular discourse by policymakers and economists on China-Africa engagement refer to export credits specifically, but it calls all Chinese flows investment. Is there an argument for treating these separately? Should export credits be considered along the lines of FDI or investment? And how does this work for quantitative social scientists like economists? And let me put one more in there from Phil Southwell. Shouldn't the US focus more on its leadership role in the rest of the world, Japan and Europe, and emerging Asia and Africa, because a coordinated response from the rest of the world will have greater economic clout? Should the US foster a more collegiate approach? So a few questions for you there, Kristen.
Excellent, thanks. These are fantastic questions. So Deborah, I'll start with your question about the club governance nature of the OECD arrangement compared to other more global institutions. What I think is interesting is that we're seeing similar dynamics in both. So the OECD arrangement is this club governance system. As you said, you know, China would sort of be a second-class citizen were it to join this. It wasn't involved in the creation of these rules. It likely wouldn't join the OECD more broadly. So it would be just a participant in this arrangement. So what we've seen here is countries like the US have no way to induce China to join the arrangement. They have no leverage because this is a club governance institution and the arrangement is focused just on export credit governance. China has no incentive to join the arrangement, and there's no possibility for trade-offs the way they would be in another institution like the WTO, where potentially the US or other OECD countries could offer China in return, and that could provide the inducement or the leverage to cause China to join the arrangement. So China has no incentive to participate, and this has caused this significant problems that threaten to undermine this governance regime. But we see something very similar at the WTO, where China has joined the WTO, has been a member for 20 years now. It was actively, welcomed into the institution. It was given a seat at the high table of decision-making within the WTO. This is a universal governance institution as opposed to a club governance institution. And yet here too, we've seen a breakdown in rulemaking at the WTO. We've seen the negotiating function of the WTO collapse, where largely due to conflict between the US and China, states have been unable to agree on a new set of global trade rules after the Doha round. virtually all of the subsequent negotiating efforts since the collapse of the Doha round have also failed due to a similar dispute between the US and China, and a dispute specifically about how China should be treated under global trade rules. So what's interesting is, regardless of sort of institutional design, we're seeing the same problems replicated across global trade governance, regardless of whether it's a club model or a universal model. And even efforts like the IWG, which was an effort to address that issue of China potentially being a second-class citizen in the arrangement. The IWG was intended to create a new institutional structure starting from scratch with sort of equal representation of developed and developing countries, build up a new set of rules with full participation of China and other emerging economies in creating the rules. And that too failed simply because China couldn't be induced or convinced to participate in these arrangements. So we're repeatedly, regardless of institutional structure, seeing the same sort of patterns in global governance. In terms of social learning, is China learning? Certainly at the WTO, over this 20-year period of its membership in the WTO, we have seen significant learning by China and a change in its behavior, socialization within the institution. So when China initially acceded to the WTO, it was a relatively quiet participant, sort of in the corners, watching what was going on for many years, much less active than we would have anticipated given its economic size and its role as a major trader. Over the years, China has gotten bolder at the WTO in terms of asserting and defending its interests as it's become more comfortable within the institution, but able to operate within it, both in terms of the negotiations and dispute settlements. So there's certainly been a shift in its behavior, and now it's undoubtedly one of the big power players at the WTO, extremely assertive in defending its interests. This question about, if you're a developing country, why would you care if China's lowering your lending costs by evading the rules of the export credit regime? Certainly developing countries will benefit from cheaper access to cheaper credit. As I said earlier, though, I think part of the big problem lies in other aspects of the governance of export credit. So things like debt sustainability, which is part of the arrangement, and this is a big concern with a lot of China's lending now under the BRI or otherwise, how sustainable this debt is. That was part of the reason that these rules were created in the first place. Countries like the US and others were also lending in unsustainable ways, lending for white elephant projects that ultimately had no benefit to developing country recipients, but saddled them with huge volumes of unsustainable debt. There were also huge problems with, hydroelectric dams, ports, other major infrastructure projects in terms of environment, displacing populations, other sort of social and human rights concerns. And these also have provisions in the arrangement to try to address this. So part of the goal of continually strengthening the arrangement and its disciplines has been to raise the bar for lending, to ensure that it benefits developing country recipients, and that there are sort of rules in place to ensure that some of the potentially harmful effects are reined in. Right now, China is entirely outside of this system, so its lending isn't governed in any way by these provisions. And I think that's really problematic for developing countries. On the issue of data, this is a huge constraint, a huge concern in terms of ever looking at China's export credit provision. The data that I'm relying on is the export credit, the US Exim Bank data, because it's sort of the most comprehensive data source, but we recognize there are huge problems with a lot of this data, and that's a function of the lack of transparency in China's lending practices. It's extremely difficult to know, exactly what China is doing in terms of the volumes of credit it's providing, the specific programs, and the terms of the transactions. And this is, the primary function of the OECD arrangement is to address that. It's to ensure that there's real-time transparency in export credit provision, that states are sharing detailed transaction data with other participants in the arrangement. So everything is happening in the light of day. There's no secret of financing terms. So it's a function of the fact that China is not a participant in this government's regime that we lack clear information about its lending practices. This question about the discourse I thought was really interesting, and the way that a lot of China's export credit activity is talked about as an investment. And I think it's interesting the way that the discourse shapes perceptions of these activities. Certainly if we were to talk about a lot of this investment once we shift to talking about it as export credit, it becomes much more clear the interests that are involved here, and that the motivations behind this lending are very much serving China's interests. They're not just sort of beneficent aid, as it's often talked about, but these are driven by economic and commercial considerations, and the desire to support Chinese economic interests, Chinese firms, and exporters is a big driver of these financial decisions. So I think the discourse and language is quite consequential. And then last, this question about whether the US should seek a more coordinated response in seeking to address its concerns about China's trade policy. I think certainly that's extremely important. There are many other countries that share US concerns, both developed countries as well as in certain areas, also many developing countries are increasingly concerned about China's trade practices. Over the past 4 years in the US, we've seen two things. One is a very incoherent strategy in terms of dealing with China and China's trade practices, or trade in general. So I think the US is really in need of a more coherent, carefully thought out strategy, and one that's very clear about what its objectives are. China is not responsible for the U.S. trade deficit. This is not, trying to address the China's U.S. trade deficit through a bilateral agreement with China to boost, U.S. ag exports or natural resource exports is not an effective solution. So a more coherent strategy, something that's more carefully thought out with a clearer set of objectives, and also that's enlisting allies who share similar concerns, is essential. And as I said, for the past 4 years, the U.S. has primarily been, alienating its potential allies, launching attacks on many of its closest trading partners, and undermining its ability ultimately to try to tackle some of its concerns about China's trading practices. But the other thing I would just say there is that it's important to recognize that China has a right to develop. And some of the discourse, the language we've been hearing from the US recently about suggesting that the US may seek to block or thwart China's development is hugely problematic. And I think the US will have difficulty enlisting allies if it takes that sort of approach. So there needs to be a balance between recognizing that China has a right to develop and to employ strategies that are necessary to foster its economic development, while also finding a way to work with allies to try to tackle some of the problematic aspects of China's trade policy.
Thanks, Kristen. We have so many questions here, and we only have time for a few others. So let me just, let me get to my question list there. Yeah, so I'm going to ask a few, and then Kristen, if you could just address them very, very quickly. So Jim Lin asks, is it fair to say that the US, as the largest economy of the world, seems to be abandoning the financing tool of export credits? I know you talked about that during the Tea Party period. Ho-Fang Hong, who's a professor at Johns Hopkins University, says that some developing countries will find that are complaining about the influx of China's industrial goods. For example, industrialists in Brazil and Pakistan's growing deficit with China. It's contributed to its balance of payments crises. So what about the prospect of different developing countries rallying behind China or behind the US in terms of these trade issues? And Sayori Katada from the University of Southern California asks how the source of the funding of export credits influences its viability, especially today when the debt overhang in the face of COVID becomes intense for many low-income countries. Can China manage financial loss better than OECD countries? And that, and she has a comment on the Japan-China comparison, agreeing with Jonas about the potential for this, and Miles' discussion on the sunset industries being funded by the export credits. She recommends looking at Maria Solis's book on banking and multilateralism. So I think, gosh, there's so many others, but we'll send them on to you if you have a few comments on those.
Yeah, thanks. These are fantastic questions. Yeah, the U.S. effectively got out of the game for a period there because of a Tea Party assault on the U.S. Export-Import Bank and the sort of, extremist free market ideology in the U.S. The U.S.'s own export credit agency was shuttered for a number of years, but is now back in the game. It's been reauthorized and is lending, and actually its lending ceiling has increased. So the U.S. is back. I think this question about the impact of China's manufactured exports on other developing countries is important, and this is an area where developing countries need probably to be working more closely together to try to address this. This is a huge issue for many countries, this influx of cheap manufactured goods leading to deindustrialization in many developing countries, and what perhaps is a multilateral solution needed to better address that and the needs of these developing countries. And this question about how sustainable this trade financing is from China or other countries is interesting. Whether China probably has a better capacity to sustain it for longer than some of the other OECD countries now, giving other fiscal pressures and pressures on their budgets going forward. But even for China, how long will it be able to sustain this is going to be a big question. So thank you very much for those great questions.
So I think we are at the end of our time here. So I want to again thank Kristen Hopewell for joining us from across the border in Canada. Thank you so much, Kristen, for your wonderful research and the great presentation today. And Miles Kaler joining us from across the river. Or I guess you're on the other side of the river. I'm the one that's in Virginia. And Jonas coming in from Germany. So we've had a truly multinational discussion here. It's been quite invigorating. And I want to remind the audience too that we have this is the second out of 7 weeks in our virtual conference. So we have a number of other very exciting speakers and panels coming up every Tuesday morning at 9 a.m. for the next 5 weeks. So thank you again to everyone, and we'll see you next week.